Fox Market Alert, it's been a rough 5 sessions for big banks that make loans. We're talking about Wells Fargo, Bank of America, JP Morgan. Wells is down 8.7% over the past 5 days. Bank of America down 5% and JP Morgan Chase down about 4%. This as bond yields head north. The 2-year yield, which best reflects future Federal Reserve policy, is now back above 3.9% at 3.956, while the 10-year yield, which mortgage rates and auto and credit card loans often tend to follow, has now hit 4.413. That, and you add with it, plus rising oil prices, puts Kevin Warsh, President Trump's nominee to take over as Federal Reserve Chair, in a complicated position. President Trump has made it very clear he wants to see interest rates cut. That's a move that's often used to stimulate a weak economy, and one some economists feel could make inflation worse. Let's bring in BlackRock Global Fixed Income CIO and Global Allocation Team Head Rick Rieder. You're not one of them who thinks a rate cut would make things worse.
I don't know. In fact, I think, could the future chairman cut rates now? I think he's probably going to have to wait for a meeting or so. I think you got to bring the rest of the committee. Clearly, people on the committee don't think it's time to do it and think we need to wait. In fact, a couple of them, I believe, think that they should hike at this point. Listen, I actually think, and exactly what you said when you introed this, I actually think if you think about what the interest rate tool is affecting today, it doesn't affect the capex that big technology companies are spending. Not at all. What it does impact is the housing market, the impact on small business, young people, credit cards, as you said, mortgage rates, as you said. And it's actually not the front end, not the Fed funds rate. What it's going to be really important to watch, and what hopefully Kevin's able to achieve, is you got to keep the 10-year point down. And I think that's going to be how you use the balance sheet, how you keep the 10-year point down, which is critical for how do we get labor mobility going, because we have better housing market.
With these yields continuing to go up, our investor audience wants to know, do we invest? Do we buy some 5 years, 7 years, 2 years?
I think today, and you've been kind enough, I don't know how long we've talked about that, this is an amazing time. I think I call it the golden age of fixed income. The reason why, not because
it's nirvana.
Yeah, not because we're going to make a lot of money on the interest rate. If we keep the rate here, which I think they will for a period of time, the ability to create income is spectacular. We can create portfolios of 6.25%, 6.5%, 6.75%. We're buying things like long-dated Italy, Spain, swapping them back to dollars. You get 6.5% yield. I spent 2 decades where rates were at zero. Remember negative rates in Europe for 9 years, negative rates in Japan?
Forever, Japan.
Oh, my God. Think about you handing somebody money and paying them to take your money. Now you get rates. Now you can create income. So if you have an equity portfolio and equities are doing extremely well, I would still stay in the equity portfolio. You get upside, you get convexity, but it's got a lot of beta. What do? Maybe I build some income alongside of it. You can build 6.5 without taking a lot of interest rate risk. That to me is we haven't seen that in a long time.
Well, be clear, where's the 6.5% coming from?
Yes, I run the CTF, as you know, called BINC. And what we do is we buy things like agency mortgages, securitized assets, high yield credit, some parts of investment grade credit, agency mortgages. We keep the rating at, on average, low single A. But because of where the risk-free rate is, because of where treasuries are, I put some spread on top of it through all these assets, diversify it like crazy, and you can get 6.25%, 6.5%. I buy a lot of Europe today. I've actually been buying more Europe because the view is that Europe's going to have to hike rates to deal with inflation. The European economy is going to slow considerably.
And BINC captures some of that.
Totally. And that to me, there's a big difference between equities and fixed income. In fixed income, I'm trying to diversify like crazy. Get you stable, 6.25%, 6.5%. Stable, stable, stable. In equities, I actually think you should do the opposite. Take risk, be in the companies that are creating growth, technology, et cetera, and then you've got what is real balance. It used to be 60-40. I had to own long bonds. Why would you do that today?
So exactly. Why would people are still doing that? And I don't think it's the greatest idea, especially with the yield you get from the stock market in many cases. But let's take it back to Kevin Warsh. The Senate is supposed to have the full Senate confirmation vote. Do you think he will pass?
I'm not into the political. My sense is yes. My sense is he will make it. He'll make it through. I think what is important to think about, when he gets in the seat, how do you think about, what that committee looks like? Chair Powell, how long does he stay in it? I will say, sitting on advisory committees for a long time in and around Fed, Treasury, it's really important that Fed works as a cohesive group. Doesn't mean you can't have dissents, But the ability for them to move forward, I think, is a big deal. For markets,
it was interesting.
very big.
This most recent meeting that was the announcement on no move on rates, April 29th, 4 dissenters.
Yeah.
One, of course, Stephen Myron, who was placed by the president, he said he still wanted a quarter-point cut, which was a lot different from the much bigger jumbo cut he had been suggesting, because even he sees you don't want to stoke inflation. The other 3, Beth Hammack, Neil Kashkari, Lori Logan, they were the ones who felt you might want to tighten a bit. But the Fed funds futures, for those of you who don't know, that is the mechanism through which investors and traders can actually bet on what the Fed is going to do, shows no rate cut at all for the rest of the year. I mean, these are measly, or might I say meager odds that there would be a rate cut. 6.4 in December? I mean, nothing.
No, and so I think there's something important to consider. Today, I think you should assume Fed's not going anywhere for a period of time. Got to get more data. You need to see inflation. We're going to get an inflation report this week that's going to show inflation's hot, and it's going to show even the core is going to be higher. You know, 4 core month to month, month over month. I think you should assume they're not going anywhere but then you get in the second half of the year. You've got a big fiscal tailwind that's kicking in. We've got a tremendous amount of capex that's kicking in. I think the unemployment dynamic is a longer-term problem. I think productivity is going to take out a lot of employment. When you get to the second half of the year, I think the thing that'll be important to watch is how does Kevin Warsh look at, we could reduce the size of the balance sheet, we could adjust the money supply, but then we bring the rate down alongside of it. And I think I'll have a window to do that. Today, do I think we need to make that bet? Not really. But I think that's where we're going to go.
But don't you need to preserve rate cuts as a weapon just in case something bad happens with the economy? And it could be some black swan event. We don't know. But also it could be that the market, which has, I mean, we're hitting records over and over again, the trees don't grow to the sky.
So,
at some point, we'll see a market correction. And wouldn't you then need that rate cut ability as a weapon?
So I think the interest rate tool is quite different than it used to be. And well, I think it's different. So what is inflation today? The stickier parts of inflation are things like healthcare, education, insurance. You can move the overnight funds rate. You're not going to impact the inflation in healthcare, education, insurance. You could help housing by bringing the rate down. The areas that the interest rate tool does affect, you think about traditional manufacturing, autos, many small business, those areas are actually in recession today. In many parts of it, those areas, small business, low income, they're actually hurting. The point being is, what is your interest rate tool really doing? If it's taking inflation down, I'm all for it. It really isn't. And the thing that you have to consider is the cost to the economy by keeping the rate up is dramatic, including we fund $520 billion a week of front-end treasuries.
Yeah.
So my point being is I think it's a very different tool. The front end of the yield curve is a very different tool. And part of why I think the areas where it impacts are actually much softer than the top line around tech stock semiconductors rally.
Just to be safe, I'm looking at the 3-month, 3.687%, the 12-month, 3.77, let's call it 3.8%. Why not just take some of the cash and put it in there just for a year?
Crazy. I mean, it's not crazy. I mean, my argument is if you don't think rates are going to move today, but maybe we start to move and you look at, you know, forward inflation expectations, they're pretty docile for where we are in the future.
So you're saying don't put it in a 12-month?
No, I think I would hold some.
Yeah,
I would hold some there, 100%. But then I'd also look at, gosh, can I build income alongside of my equity portfolio? Maybe I go a little further out the yield curve, but I don't need to go that far. I can go 3 years, 4 years. But then can I put income attached to it? And can I clip 6.25, 6.5? That maybe if rates come down, the 6.5 becomes 8.5, 9. Like the last 3 years, you enable fixed income in these types of funds to get 7, 8, 9% returns.
Good to see you, Monsieur Rieder. Thank you very
much.
much.
Thanks for having me.